This is the part of the show where we put a fund in the spotlight, and this week we're reviewing the Sanlam Investment Management Fund. So, Cobie, over to you.
Okay, well, again, we're looking to numbers up to the end of June 2011 here. The manager for this fund is Patrice Rassou. Interesting to see here that the formation date for this fund, there's two different sets of units here. The one set of units are what we call A units, which kind of is August 2004, but then there's a much longer track record, which they call R units, which go back to June 1967. So that's quite interesting. This must be one of those funds that have been in existence for the longest in South Africa. It'll be interesting to see what those very long-term numbers look like. You can see some total expense ratios there on your screen at the moment, and the objective obviously is a total return index for the JSE Aussie. Let's just quickly look at returns for this fund. Over the long term, so for the 5-year period which we're going to look at today, is 13.6 versus 11.4, denoting skill relative to the all-share index. 3 years is 10.8 versus 4.5. 2 years number, 22.9 versus 23.2, and then over the shorter term, 12 months, is 23.7 versus 24.6. Now let's just have a look a little bit at the fund and just look at some of the dynamics that have been at play specifically in this fund. You'd be getting used to this chart that we put up every week. It's got the rolling all-share index over here, which is a total return all-share index over here, and then the fund relative to its benchmark. So anything that's below the line would denote an underperformance relative to its benchmark. And if you look at an area such as that over there, well, that will denote an outperformance relative to its benchmark, what we call an active return, specifically in the industry. So if we go back here and we just look at the 2007 period, you can see that Patrice actually has decent outperformance relative to the benchmark. That outperformance turns into a negative active return, which is the underperformance as the market kind of corrects itself during 2008 and 2009. And then, as he quite rightly said just now, he's a pragmatic value investor. Yeah. And as that cycle then turns and it gives him the opportunity to go and invest in cheap companies, well, bang, there you get it. You get the outperformance for the fund on that side. A fairly flat market at the moment as a kind of all share continues to kind of peter out, and the correction has happened. Eleni, over to you.
Okay, thanks for that, Cobie. So, Roland, what are the major risks involved with this fund, would you say? Because I see here that Anglo American still remains the largest holding for the company, of course, out with fantastic results as well.
Well, generally, when we talk about risk as a quantitative analyst, we tend to look at the exposures rather than the weights. Yeah. So although there's a high weighting in maybe the resource stocks, I've actually done a bit of analysis, and this fund actually has what we call a low beta to the resource index. So it's actually quite a conservative fund. The beta to the market or to the benchmark, in other words, the sensitivity of this fund has ranged from 0.5, so when the market goes up 10%, this fund would go up half of that, or 0.5 times the move, up to a beta of about 1. It's currently sitting at a beta of about 0.75, which means it won't move, if the market comes down, it won't move as much down. So that's a kind of a good thing if you believe markets are coming down.
Okay, so we know that you're a skills man. Do you think that there's skill?
Well, you've got to take a view on the market. So if you think the market is going to go up and this fund is conservative, it might not deliver the returns you're expecting. Yeah. However, if you think the market's coming down and you want to have an equity exposure, then this is the kind of fund
you need. Is that a yes or a no?
Well, in my opinion, it's a yes, because I think markets are coming down.
Well, very great news for you, Patrice.
I'm glad from the master himself.
Absolutely. Okay, so, I mean, what is your view? I mean, are you cognizant of the fact that it's low beta, so you're looking at more of a conservative play here of the markets? Would you agree with that?
Yes, I mean, we really base our stock picks on the valuation of the individual stocks. And our view is, on an overall basis, there's very little value in the market at this point in time. So what we're trying to do in the fund is to pick those stocks which are likely to outperform the market, but at the same time, the sort of risk-return equation is such that we don't find, as opposed to what happened in 2008, we don't find really the opportunities to get exposure to stocks which have got high expected returns versus the level of risk. Another way to look at it is, if you look at just a rule of thumb, the proportion of stocks which were trading 3 years ago at P's of less than 10 was a big portion of the market. Right now there's been convergence in valuations, and most of the stocks in the market are trading at P's of closer to 11, 12, which are sort of in line with their long-term average. So We not decidedly sort of, it's not something which is conscious, but valuations are telling us that there's no point to take a lot of risk in this fund at this point in time.
Okay, so Patrice, we have to wrap things up. So just very quickly, your view overall in terms of where we headed on the equity market space in emerging markets. Do you think that ultimately a lot of focus is being shifted back to the developed world, and that's where we'll see the returns that we've experienced in emerging markets now shifted to the likes of the developed world?
Yeah, I do think there's more value to be had investing in equities in the developed world. Obviously, the situation is quite sensitive right now, given all the potential tail risks that we're seeing. But it's quite interesting. That said, that despite, as Roland said already, the high expected level of risk, you know, with the U.S. sovereign debt situation, the Greek situation, the sort of whole banking uncertainty with the stress test in Europe, that markets in the developed world are actually up year to date. So often, as Warren Buffett says, you know, you have to be greedy when others are fearful, and the place to be greedy is really offshore in markets which are perceived to be more risky, and where you can pick up very good quality blue chip companies at very attractive valuations.
And fearful perhaps when others are greedy, indeed. Okay, very quickly, 10 seconds, Cobie.
You're getting the international companies cheaper than you're getting the global companies.
I think markets are going down, and I don't. If Patrice can pick the value stocks for me, then I'm happy for him to do that. So.
Fantastic, great. Thank you, gentlemen. We have to say goodbye. Much appreciated for joining me this evening.